Let's get in. Get in. Ed Yardeni, President at Yardeni Research. He's with us. Ed, thank you very much for joining us. Now, I don't know if you saw Scott Bessent's interview over the weekend on
Yes,
Meet
I
the
did.
Press. Very interesting, right? Here's a market man, when asked about the market falling, saying, "Well, it's okay. It's normal. It's a normal, healthy correction."
Yeah.
And I think there was also a question on recession. He said, "Well, I can't say for sure whether there will be or will not be a recession." So they seem to be pretty okay with this fall that we're seeing.
Well, I think a lot of us on Wall Street are disappointed with Scott Bessent. We thought he was one of us. We thought he was a market guy and that he understood that markets mattered. But now he's kind of dismissing us. No, he's not one of us anymore. And that's actually a little disturbing, right? Because markets do matter. Markets do vote. They do give you an opinion. And I think to dismiss a 10% correction in the S&P 500 and more than that in the NASDAQ is fine as long as it doesn't turn into a bear market that lasts a long time. And they're kind of like messing around with nitroglycerin. This is very, very dangerous to basically tell people that the administration doesn't care very much if we have a recession, because the short-term pain is going to be for long-term gain. And nobody believes that. Nobody believes it until they see it. And meanwhile, Americans don't do pain very well. They voted for a president that they thought would make things better, and they're not that patient. So it could be an issue for the midterm elections.
Is the correction over, Ed, in the U.S., in your opinion?
In my opinion, no. I am very... it's very bullish to see that bearishness is so high. We have very high bearishness sentiment indicators for the stock market, and that usually makes a low. But the reason it makes a low is because, coincident with people getting extremely pessimistic, is that the Federal Reserve recognizes there a problem and comes in, and we get the Fed put. We get the easing by the Fed. This time around, the Fed has indicated quite explicitly there are no hurry to lower interest rates. They think the economy is still resilient. Meanwhile, they have all the uncertainty as the rest of us do with regards to tariffs and whether tariffs might boost inflation. And the last thing they want to do is lower interest rates, even if the economy is weak, if inflation's actually heating up again. So that's my problem. The other problem is I'd like to see the market do better on a day when Trump is talking about tariffs. I've come to the conclusion that any day without Trump talking about tariffs is a good day for the markets. And that's what we saw on Friday, as you mentioned.
Absolutely. I take that point. But that the comment was, it caught, I think, everybody's attention, because he wasn't only talking about tariffs, Mr. Bessent. He was saying that we are warding off a guaranteed financial crisis. He's talking about the deficit and the spending, right? And he also indicated back to 2007 and 8. He said that at that point, if the excesses had been stopped, we wouldn't have had a full-blown global financial crisis. I don't know. I mean, it seemed to indicate more than just the current tariff issue, which is what the market is primarily fixated on. The government shutdown and the spending, that's not yet so sort of front up in the narrative. It seems the market's problem is tariffs and inflation. But could the government cuts, more spending cuts if they come in, could that kind of feed into it as well?
Yeah, I think that I recall that his predecessor, U.S. Treasury Secretary Janet Yellen, once said that there'd never be a financial crisis again, or she thought it was very unlikely in her lifetime. And then we got the pandemic, and we had a financial crisis. So I think it's always unsettling when you hear a policymaker saying that what we're doing now is going to avert a financial crisis, when the reality is they really haven't done anything to reduce the deficit. If we have a crisis, it's going to be related to the extreme amount of debt relative to GDP in the United States. It's very interesting to see that the bond yield has been very, very quiet around 4.3%. You would think that with concerns about a recession rising, that the bond yield would come down. That's not happened at all. But I think right now, Bessent basically is borrowing a lot of money in the Treasury bill market. And so that's kept the bond market relatively quiet. But there's a lot of securities that have to be refinanced this year, and the debt issue certainly has not been resolved. And there's still lots that has to go through Congress with regards to fiscal policy. All we've done is kick the can down the road with regards to the budget.
Right. You know, Ed, the overarching theme is, or belief is, that Trump is a man of action, listens to business, listens to what, the markets are saying. Do you think with what the markets are making of his tariff announcements, etc., there could be a case for him rolling back some of them, or maybe, toning his narrative down a little bit?
Well, I hope so. I hope he just doesn't remain bullheaded about his tariffs. He has bragged many times and called himself tariff man. And I think all of us on Wall Street, including myself, had the illusion, maybe delusion, that all Trump was really going to do was bluster. He was going to huff and was puff. And then once he threatened the tariffs, that there'd be negotiations to bring the tariffs down. But he's also said that he's really intent on using tariffs to raise revenues, which means permanent tariffs. He's also said that he wants tariffs to discourage companies from producing abroad. He wants more companies to come back to the United States, which means permanent tariffs. And he's kind of compared himself to President McKinley, who also used tariffs to bring revenues into the United States. The risk is the comparison that will be relevant is Herbert Hoover, who signed the Smoot-Hawley tariff. Tariffs are bad news. And right now, it's interesting to see that foreign stock markets are outperforming the U.S. stock market, suggesting that at the end of the day, tariffs might be actually worse for the United States than for the rest of the world, because the rest of the world is still going to operate with the same tariffs relative to one another.
Got it. So through this, so April 2nd, right? And what happens into that day, and I think that'll be interesting.
Yes.
But it's interesting. It's John Authers, the the Bloomberg columnist now. He wrote a piece saying why Trump cares less about market pain now, and I think there've been others who've been pointing this out as well. I spoke with Louis Gavicle 2 weeks back, and he said, well, he doesn't really care. I mean, they're not focused on the S&P. They're more focused on the 10-year. And when I say they, I mean Trump and Bessent, etc. So that's interesting. We'll see. I mean, now that those thresholds are being tested, maybe that Trump put is not here. It's a little lower. Who knows? But India, any thoughts, Ed, and how we are placed? We've already kind of corrected quite a bit. And last week, as US was correcting, the market held on.
I think that's a very good sign, because for a while there, India was going down along with the United States. And both the United States and India had big rallies, and the valuation multiples were stretched. So it certainly looked like global investors were moving out of high-valued stock markets like the U.S. and India and into China and Europe. But it is, I think, encouraging to see that India may be very well bottoming out before the United States bottoms out. And that, look, there's clearly a lot of liquidity in the global economy. And if money is coming out of the U.S. stock market, there's certainly enough to diversify into the Indian market. But I think to the extent that the tariff situation gets worse between China and the United States, I think India benefits from that, because I think more manufacturers will, in fact, move to India. And I have clients who are telling me that's exactly what they're doing.
Oh, okay. That sounds good. We don't mind that at all, Ed. Thank you so much for thank you so much for joining in and giving us that perspective today. Thanks very much.
Thank you.
Well, with that.